Hello, class, and welcome to our 11th lecture series on financial accounting or principles of accounting. And I'm your instructor, Jamal Haider. Okay, to begin with, we are starting a new chapter after the midterm. Let me just sign up my mobile. Good. So this is the short-term investments and receivable. So we are not discussing the short-term investment part because I think that is more relatable to finance stuff. So I'm gonna just skipping that one. So we just focus here on account receivable. Let's just talk about that. Account for and control account receivable. Let's just talk about it. So we know that what is account receivable? These are customers, right? So how account receivables are created? When we sell on credit, right? Not on cash, on credit. If somebody, place an order with us, so what is going to happen? Naturally, because the big companies, they have orders in millions of dollars. So normally they are on credit, right? So it's a normal business routine that companies are dealing with credit sales, okay? So remember, recall our earlier discussion in which we talk about we are learning this accounting with perspective of cooperation, not partnership, not the sole proprietorship. Okay, we already closed that discussion over there. So because real implementation of accounting is in companies, corporations, right? So it means companies are directly selling to its customers. So its customers are normally retailers, agents, big agents, big clients. So normally they place orders and company deliver them because company has a past history with them. And normally these are on credit, right? But if they are having a cash sales, company will mention, okay, the company, sell on cash, right? Okay, so we know that it is also the liquid asset, a current asset, type of current assets. Cash is the most liquid asset. Cash equivalents are also the most liquid asset. And then comes account receivable because their life is less than 1 year, right? So that's why we categorize this as current assets. So what are these? These are monetary claims against others. Our monetary claims against other, which means companies' monetary claims against other. Company delivered the goods. Now company has to receive the amount, right? So they are created by selling goods, right? Or by lending money, like notes receivable. We'll talk about notes receivable in coming slides. So just gonna give you a little brief here. So when you sell the goods, receive cash, that's it, right? So what if somebody is giving you time instead of cash? He's giving you, okay, I'm gonna give you money after 30 days. So you can think about that, okay, if I'm giving you lending credit, this time lending time period, so I'm gonna be charging interest, right? Or some charges because I have blocked my money with you for 30 days. You are going to give me return my money because I transferred the goods immediately. You received the good, but you are giving me the money after 30 days. So I'm going to be charging you some interest or some, profit on that or some charges on that, right? So if you understand this kind of stuff, it is kind of like lending money. Sale happen, but money is going to be received after 30 days. So for 30 days period, you receive some kind of interest, some kind of markup, profit or something. So this kind of arrangement is called notes receivable. It's normally happen when the client is new or, or the client is having a cash history, but now entering into, asking you to give the, goods on credit, right? So then because you don't have established past credit history with him, so you arrange this kind of stuff so that everything looks more, legitimate, legal, just like that. So if customers, if a client refuse to pay, so you have legal documents and you can just sue him whatsoever, right? So this is also, but this kind of arrangement is, very limited because companies, normally don't deal with big monies to a new client. Okay, let's move forward. If you have any question, you can raise your hand. In this case, you can just stop me and you can say that, okay, sir, I don't understand this point, please explain. Okay, so please ask as much as many questions, it comes to your mind. So, like I said, how account receivables are created? Number one, when sale happen, right? When sale happen, you transfer the goods, right? So now the second thing is cash is coming in to the business or client is paying off his debt. So when sale happen, what would be the entry? When credit sales happen in this case, when you sell the goods to a customer on credit, what is the entry? Here, account receivable is your asset. Asset increase, debit. Sale increase, credit. And how we pronounce it? Account receivables to sales or sales revenue or just revenue. Sorry, service revenue or just revenue. In case of if you are delivering service, so you record service revenue. If you are delivering, goods, so you just record it revenue. So don't just bother here. Just remember the concept of having sales, account receivable to revenue or account receivable to sales, right? So when cash is received, it means account receivable decreases and cash increases. Cash is also asset, cash increase. Okay. Entry would be when they pay off their debt, cash to account receivable. When they pay off their debt. So in case of not receivable, when you deliver the goods against not receivable, it means you are delivered the goods and blocking the money for 30 days and charging the interest. Entry would be not receivable to cash. Or in this case, you are lending money, not lending goods. Okay, so then just because this seldom happens, okay, or the company transfers some money to their subsidiaries companies or sister companies, so that's why it seldom happens when you give loans to your other companies or some big clients who are working for you. So it seldom happens, so don't worry about this. So lending money, when your money is lending, cash is going out, cash decrease, cash is credit, not receivable is your asset, current assets. Current assets and current asset increase mean debit. So not receivable to cash, but focus here. So that is our prime, you can say the entry. So account receivable to service revenue or account receivable to revenue. And when cash come in, you decrease the account receivable, you record as cash to account receivable. So again, let's just define, we already defined it. So amounts collectible from customers from the sale of goods or services. They are also sometimes called trade receivable. So some books, it is, trade receivable. So instead of writing account receivable, you write trade receivables. So normally this happen in British, books. So if the author is British, he would be, mentioning it at trade receivable. So don't just worry about that. So account receivable also can be used as a control. How is that? Because we talked about internal control when we were talking about the handling of cash, right? So account receivable also can be used as a control. How? Because it summarizes all the total receivables from customers, and a separate control, separate account for each customer is to be established. So let's just talk about this. So in reality, we don't have one client. We have 100 or 1,000 clients. So every client has its own name. For example, here, see, we have Brown, we have FedEx, we have Moody's, right? So if we sell goods to Brown, entry would be, Brown to sales. Brown to sales or revenue. So Brown is your account receivable. So you make individual account Brown, similarly FedEx, similarly Moody's. So account receivable is generic, is a total of all the individual customers. See, you add all these. So Brown plus FedEx plus Moody's. Let me just clear this mess. Brown plus, Brown plus FedEx plus Moody's. Here, 9,000. So you see, we sold goods to our customers on credit. Entry would be account receivable to service, right? So that's why we call this is a generic or journal account. And if we want to see that among 9,000, how much we sell to the Brown, how much we sell to the FedEx, how much we sell to the Moody's, you can see here, right? So these are individual or subsidiary account of account receivable. So you can just so you can see that, okay, this is account receivable. And here you have Brown, I just denounced it with B, and then FedEx, and then we have Moody's. For example, here it was like 5,000, it was like 1,000, and it was like 3,000. Right? So bigger or generic would be account receivable. Inside you have, so in software it is very easy, right? You double click on account receivable, window open, and there are 100 or 50 your main customers to whom you sold the goods on credit. So Brown, Moody's, and FedEx, it's over there, right? But in Office, in reality, if we are managing in books of accounts, so we have one big register, big book here. Okay, so big book. Inside on contents, we write it down, okay, from number 1 to number 10 pages, this account is for the Brown. Number 20 to 30, and these pages belongs to FedEx. From number 30 to 40 belongs to Moody's, and register name is account receivable, right? So these are subsidiary accounts, right? So this is just, I want to give you the update on how in actual we record it. So we do have the name. So these are Browns, and these are under account receivable. So it means Brown is our client, FedEx is our client, Moody's is our client. Okay, account receivable. So note receivable, like I told you, if we lend money to someone else, note receivable can be created in 2 ways. Number one, if we lend money, for example, to our subsidiary companies, or if we are expanding in different region, so we lend money to our subsidiary company over there to start a business. Actually, instead of going to the bank and asking money, because banks need some kind of proof, history, and all the stuff. If you don't have the required documents, then interest rate would be very, very high. So it's like that. So rather going to the bank, you ask money from your parent company. Or like I told you, the arrangement, if client is new, backed by some security check, and you want to send the goods and he's going to pay you later, you don't have established prior established history with you. So it's better you secure yourself and you say that, okay, I'm going to be blocking my money for 30 days and I will be charging some interest. So you open note receivable. So similarly, in note receivable, you have a company letterpad. Okay, XY company. Okay, this is the client name. We are giving you this much worth of amount of good. For example, 100,000. It's like type of lending. In number one case, we lend you money 100,000. In second case, we are giving